Can a machine predict the next big stock market crash? This is a question that keeps investors up at night. We all remember the stories. The dot-com bubble of 2000, the financial crisis of 2008. These events wiped out fortunes. They changed lives forever. For decades, we have relied on human experts. These are the seasoned analysts on Wall Street. They study charts, they read reports, they use their experience to guess what comes next. But now, a new player has entered the game. It is called artificial intelligence, or AI. It promises to see things that humans miss. This new technology is not just a simple calculator, it is a complex system that can learn. It can analyze vast amounts of information in seconds. Imagine a library filled with every financial report ever written. AI can read it all in the time it takes you to drink your morning coffee. The dream is to have an early warning system. Can an algorithm truly outsmart the collective wisdom and fear of millions of human investors? Artificial intelligence is already all over Wall Street. You just might not see it. It works quietly behind the scenes. It helps investment firms make faster and smarter decisions. One of the most common uses is called algorithmic trading. Computers are programmed to buy and sell stocks at incredible speeds. They follow a set of rules. For example, if a stock drops by a certain percentage, the AI might automatically sell it. This happens in fractions of a second, far faster than any human could react. These systems handle a huge portion of trades on U.S. stock exchanges every day. AI is also used for risk management. Big banks and hedge funds manage billions of dollars. AI can analyze entire portfolios. It can simulate thousands of future scenarios. Another area, robo-advising. Online platforms use AI to manage investments for regular people. Finally, AI analyzes new types of data. Now AI can scan millions of social media posts. It can analyze satellite images of retail parking lots. The goal is an edge. This is called alternative data. It gives investors a real-time glimpse into the economy before official reports are released. For generations, Wall Street has relied on human experts to navigate the market. These analysts use a combination of art and science. One of their main tools is called fundamental analysis. This is like being a detective for a company. They read annual reports, income statements. They look at debt levels, cash flow, profit margins. They try to figure out what a company is truly worth. Another popular method is technical analysis, and more about the stock's price movements. They use indicators with names like moving averages, support, and resistance levels. For example, a pattern called a head and shoulders is often seen as a sign that a stock is about to fall. Beyond the numbers, human analysts rely heavily on something else. For instance, what is the quality of the company's management team? Is the CEO a visionary leader like Steve Jobs was at Apple? This gives them a feel for the business that you cannot get from a spreadsheet alone. Finally, Wall Street experts are always watching the big picture. They watch for changes in interest rates from the Federal Reserve. When we compare AI and human analysts, we see very different strengths. AI's biggest advantage is its sheer power and speed, and AI can analyze millions of data points from around the world in an instant. A human analyst, no matter how dedicated, can only process a tiny fraction of that information. This allows AI to spot correlations and patterns that are invisible to the human eye. The machine can see the entire forest, while the human is often focused on just a few trees. Humans, on the other hand, have a key advantage in understanding context and nuance. For example, a CEO might say something in an interview. An AI might analyze the words, but a human analyst might know that this CEO is always very cautious. AI systems are also completely free of emotion. Fear and greed are the two biggest enemies of an investor. An AI will stick to its programmed rules. An AI can analyze data about past panics, but it cannot understand the feeling of panic itself. An AI is only as smart as the data it learns from. For predicting market crashes, AI consumes staggering amounts of information. Traditional market data is the first category. Historical stock prices, trading volumes, volatility indices, like the VIX, the fear index. AI looks for statistical patterns before past crashes, low volatility periods, followed by sudden spikes in trading volume, often preceding sharp market declines. NLP lets AI read human language, news articles, the Wall Street Journal, official company filings, transcripts of CEO conference calls. The AI hunts for shifts in sentiment, satellite imagery, counting cars in mall parking lots, credit card transaction data, consumer spending trends, millions of public social media posts, X Twitter, sudden spikes in posts saying recession. Machine learning ties it together. Think, 2008 crash. It learns combinations of signals tied to crashes. That mix can show a 70% correlation with a drop in the next 3 months. It's mapping a complex web of interconnected signals. And it constantly updates as new data pours in, searching for faint signals in the noise. Relying too heavily on AI for investment decisions comes with significant risks. One of the biggest dangers is the problem of overfitting. This happens when an AI model learns the past data too perfectly. For example, it might notice the market crashed every time a certain sports team won a championship. That's coincidence, not cause. The AI can't tell the difference. Another major risk: AI is very literal. It only knows the data it was trained on. A completely new event can confuse AI. This is called a black swan event. The COVID-19 pandemic is a perfect example. In early 2020, many AI models trained on economic data saw no reason for a crash, and used common sense to see the global risk. There is also the danger of a flash crash. Automated trading algorithms can go haywire and plunge the market in minutes. We saw this in the US on May 6, 2010. The Dow plunged nearly 1,000 points in minutes, then recovered most losses soon after. Other AIs saw prices dropping and started selling automatically. Finally, data bias. Example: trained only on the last 20 years, a low-rate period. These AIs can become a black box. Even designers may not know why a prediction was made. Looking at real-world examples in the United States gives us a mixed picture of AI's predictive power. On one hand, some specialized hedge funds that rely heavily on AI have shown impressive results. Renaissance Technologies, founded by mathematician Jim Simons, their Medallion Fund has produced incredible returns for decades. They use complex mathematical models and AI to exploit small temporary inefficiencies in the market. Instead, their AI makes millions of tiny rapid-fire trades. Many AI-driven funds did not successfully predict the 2008 financial crisis. The crisis was caused by complex financial products called mortgage-backed securities. Similarly, most AI systems failed to predict the sharp sudden crash in March 2020 caused by the COVID-19 pandemic. The trigger was a biological event, not an economic one. There have been some reported successes though. Some firms claim their AI models gave them early warnings before smaller corrections. For example, before the market turmoil in late 2018, some AI systems reportedly detected rising risk, picked up on increasing trade tensions between the United States and China. These systems were able to flag a combination of risk factors that suggested a higher probability of a market downturn. Ultimately, the performance of AI in the real world has been inconsistent. The market is a complex adaptive system. The very act of prediction could alter the outcome. In the age of AI, it is easy to dismiss the value of human experience. A veteran investor who has lived through multiple market cycles has a type of wisdom that cannot be programmed into a computer. They remember the feeling of the dot-com bubble bursting in 2000. They can recognize the smell of a speculative bubble. Human experts are also crucial for understanding the big picture. For example, a human analyst can understand the long-term implications of a new trade agreement. Furthermore, humans are essential for asking the right questions, but it needs a human to tell it what to look for. This partnership is powerful. Finally, the human element is irreplaceable when it comes to communication and trust. They want guidance from a calm, experienced human advisor who can explain what is happening. So, can AI outsmart Wall Street and predict the next big crash? After looking at all the evidence, my opinion is clear. Not yet. AI is an incredibly powerful tool, but predicting a massive systemic crash is a different challenge. They are black swan events. In those moments we need human adaptability. It's man with machine. The best investors will combine human insight with AI's analytical power. The human acts as the strategist. The AI acts as the super analyst. View AI not as a crystal ball, but as a more powerful telescope. The best defense: wise, long-term diversified strategy.